Now, and Nina, some really great reporting went into this piece. I know that you looked at 75 of the largest acquisitions over the past 5 years. Walk us through some of the main takeaways.
Thanks for having me, and happy to. So we found that less than half of companies managed to cut their debt levels to the degree that they promised to. We also found that almost a third of companies had leverage ratios above 3.5 times, and we also found that average leverage ratios were higher. So basically, companies were too optimistic going into those deals, took on too much debt, and are now facing the situation of higher interest rates, slowing economy, of how to bring the debt down.
And it's interesting, you have some specific examples in here. You focus on Walgreens Boots Alliance. Of course, they bought Summit Health City MD about a year ago, and it's been interesting to see how that's been handled by the rating agencies.
Yeah, so we recently saw that Walgreens was downgraded to junk the first time since the company's creation. The company is now considering to divest its UK arm Boots, which it had been in discussions for before, but then decided to not do that because of the offerings that it received. There are questions about this health care service push that Walgreens has attempted, and this is just one of the companies, I think, where sort of just the combination of factors is the problem. And we also have some other examples in the story, looking at, for example, Bayer Monsanto and also Oracle Cerner, where basically companies are still in the process of deal making or are already hitting these roadblocks. Bayer Monsanto, of course, is a well-known case where the company just underestimated the volume of litigation that would come with buying the weed killer owner.
I want to go back to one of the main points you mentioned, which is less than half the companies you've examined have managed to cut their leverage ratios since their acquisitions. Why is it so difficult? How come it's so difficult for these companies to bring down their debt?
I think it's to do with the timing. So the fact that they took on potentially too much debt, plus also then that there is, of course, a limited time window during which they have agreed to bring down leverage. So the goals were potentially too ambitious. Plus, they're doing that at a time when you have slowing spending from consumers, you have slowing spending from governments, from businesses, and therefore sort of the overall economic backdrop is not necessarily helping. Like, we've been waiting for a recession here in the US for a long time. It hasn't necessarily happened, but still we've seen spending decline. And so one good thing for the companies, one has to point out, is that ratings firms so far have been pretty lenient with them. So we haven't necessarily seen a huge amount of downgrades, apart from, for example, the Walgreens example. So we've been finding that ratings firms have actually given those companies a lot of leeway to achieve the targets, which should hopefully be beneficial for them, assuming that they get to achieve their targets.
That's a good point. You know, I guess the question then becomes, how much of a problem will these high debt loads, relatively high debt loads, be for companies in 2024, now that we've finally heard from the Fed that they're ready to pivot?
Yeah, so I guess some of these companies might be breathing a sigh of relief because they're anticipating that the Fed will cut rates next year, which could make it easier for them to refinance. We are expecting a fair amount of refinancings to come to the market. So those companies that borrowed cheaply in 2020 during the pandemic, many of them will have to refinance next year. And so some of these companies that did do deals will likely look at that as well, with the prospect of potentially lower interest rates that could take away some of the pressure. But in the end, sort of some of these M&A deals that we looked at, they're facing like fundamental problems in their M&A. So I think strategic issues will not necessarily be taken away just by the easing of financing cost pressure.
All right, Nina, really appreciate your joining us today. Nina Trentman with, of course, The Big Take.